Welcome back to League Update, where I break down this week's biggest economic stories in clear, viewer-friendly terms. I'm your host, Mr. GAI. Let's dive in. Last week started strong. On July 28th, the Dow Jones Industrial Average rose about 0.5% to close near 44,902. The S&P 500 gained around 0.4%, hitting a record high for a sixth straight session, while the Nasdaq added 0.3%, marking its 10th record close in recent trading, driven by optimism over potential trade deals with the EU and Japan and upbeat corporate earnings across sectors. But the tone shifted dramatically by midweek. On August 1st, U.S. President Trump unveiled a sweeping tariff package hitting 66 countries, including Canada, the EU, and Taiwan. These duties, set to take effect on August 7th, range from 10% to as high as 41%, and immediately rattled markets. The Dow plunged more than 500 points, or about 1.2%, while the S&P 500 fell 1.6% and the Nasdaq dropped 2.2%. Part of the concern arose from new labor data. The July jobs report showed only 73,000 new positions added over 3 months, triggering downward revisions to prior months' numbers. That dovetailed with the tariffs to cause widespread fear of rising inflation, slower hiring, and uncertain growth. Investors began pricing in possible rate cuts by the Fed. Meanwhile, Trump fired Bureau of Labor Statistics Director Erica McIntyre, suggesting the jobs data was manipulated. His National Economic Council advisor even called U.S. labor reports very unreliable. This sparked bipartisan concern that data credibility, and thus market confidence, could be eroded. Moving to the broader economy, despite the turmoil, second quarter GDP grew at a 3% annualized rate, recovering from a negative 0.5% contraction in Q1. But economists warn this may overstate real strength. Much of the growth reflects inventory shifts tied to delayed imports ahead of tariff increases. Importantly, studies show the new 2025 U.S. tariffs and any retaliatory measures may shave 0.5 percentage points off GDP in both 2025 and 2026. The cumulative economic impact could shrink the U.S. economy by about 0.4% in the long run, translating to roughly $115 billion lost in output annually. That's also expected to raise unemployment by 0.4 to 0.7 points and reduce payroll employment by nearly 500,000 jobs by year-end. The Federal Reserve, meanwhile, decided to hold interest rates steady at 4.25 to 4.50%. However, 2 members diverged from the consensus and voted for a rate cut, signaling internal tension. Chair Powell reaffirmed caution, citing persistent inflation risks despite softer job growth. Also notable last week, countries rushed to finalize trade agreements ahead of the August 1st deadline. Deals with South Korea, Vietnam, and others offered relief from steep tariffs. These smaller arrangements boosted bond yields expectations and helped cushion markets from even deeper losses. In tech news, big tech continued to impress. Microsoft's Q2 earnings exceeded forecasts and joined NVIDIA in the over $4 trillion market cap club, fueled by strong AI and cloud demand. Amazon, Apple, Meta, and Alphabet all beat estimates, though guidance was more mixed. Palantir rose more than 3% heading into its earnings release. So, what does this mean going forward? Expect continued volatility. Tariff deadlines, incoming data about inflation and spending, and corporate earnings all will matter. Watch key indicators like ISM Services PMI and durable goods orders in the coming days. At the same time, uncertainty around trade policy and labor data is putting pressure on investment decisions. Consumers and businesses may pull back, while markets navigate the tension between short-term risk and longer-term opportunity. That's your League Update for this week. I'm Mr. GAI. If you found this helpful, like, share, and subscribe, and I'll catch you next time with the stories that really matter.